Guys and girls, welcome back to another Beaumont Outlook's fundamental education video. And today we're discussing the participants of the FX market. Now, who are the participants of the FX market? The foreign exchange market is the largest and most liquid financial market in the world, involving a wide array of participants. These participants play various roles, from providing liquidity to setting exchange rates, and they operate on different scales and for different purposes and objectives. The majority of retail traders are under the illusion that only investment banks, hedge funds, and financial institutions are the only participants in the FX market. And this is completely incorrect. Numerous mechanisms of FX are utilized to generate volatility and market movements, from geopolitical relationships, sovereign wealth fund conversions, to banking instruments. Now let's start off with the most obvious one, central banks and governments. Now their role is to implement monetary policy, manage currency stability, and sometimes intervene in the FX market to influence their currency's value. Their role as well is to regulate and maintain to their best ability a currency that reflects economic health and stability. Now they do this to stabilize the economy, maintain a healthy level of inflation, which tends to be the 2% mark, and manage exchange rates. Central banks play a critical role when adjusting monetary policy to accommodate economic stability, both in expansionary and contractionary cycles. Commercial banks and financial institutions. Their role, well, they're the largest players, facilitating the majority of foreign exchange transactions for both clients and themselves. Their purpose is, of course, to profit from currency trading, provide liquidity, and offer FX services to clients. Financial institutions indeed play both sides of the coin. Not only do they offer day-to-day services to meet their clients' needs, such as executing futures contracts to lock in stable rates or convert currencies from one account to another, but more importantly, they take advantage of the volatility within markets. Now, corporations and multinational companies such as Tesla, McDonald's, Amazon, these big global companies, their roles, well, they also participate in the FX market. They do this to manage risk associated with currency fluctuations and conduct international trade. The purpose as to why they have a hand on the FX market is to protect against adverse currency movements and convert currencies for international transactions. Now, multinational corporations that operate on a global scale require numerous fiat currencies readily available to transact and conduct business on all corners of the globe. At times, they may require some currency more than others. For example, they may need a bit more dollars than they do need pounds, or may even convert from one currency to another to protect themselves from devaluation or uncertainty. Investment funds now. Hedge funds, pension funds, mutual funds, these sort of companies here, they trade currencies to diversify their portfolio, hedge against risk, and of course, profit on movements. Their purpose is to achieve investment objectives, including, of course, risk management and profit generation. Majority of the retail market assumes investment banks and investment funds to be one of the same. Yes and no. As mentioned in previous slides, commercial and investment banks provide services to aid their clients, and of course they trade alongside it. Whereas investment funds specifically onboard investment capital to actively seek return on investment and ROI only. Now, people like yourselves, speculators, traders, and of course retail brokers. Roles, well, brokers facilitate access to the FX market for individual traders who participate in the market primarily for speculative reasons. We're here to trade currencies, to profit from changes in exchange rates, and to, of course, profit from short-term fluctuations. We like to take advantage of pricing inefficiencies between different markets or instruments for profit as valuations are changing. Now, an overlooked participant, governments and international organizations. Now, their role is, of course, to engage in the FX market for international financial transactions, including aid, financing, and stabilization of funds. Now, the purpose behind this, of course, is to support international trade, financial stability, and economic development. Now, a good example with regards to government and interventions globally, or let's just say participation globally, is in 2011, when a tsunami hit Japan. The Japanese yen strengthened for 3 weeks after it. Now, the assumption instantaneously by market participants is that the tsunami would reduce economic output, leading to the yen to depreciate as their economy would, of course, contract. But to the market's surprise, this was completely incorrect and speculative at best. Due to donations made by governments worldwide, numerous economies selling their own currency into yen to donate to Japan led to the yen to appreciate for 3 weeks straight. Such as the UK government, they were selling so much pounds and converting so much pounds into yen to send the yen to Japan to donate. Of course, this led GBP JPY lower, as of course we were selling pound, buying yen, and donating it to the Bank of Japan and the Japanese government. Now, that's a little insight into the participants of the FX market. Each of these participants contribute to the depth, the liquidity, and the efficiency of the FX market, playing a unique role in the global ecosystem of currency trading. Their interactions determine the real-time dynamics of exchange rates, reflecting a complex interplay of economic indicators, market sentiment, and geopolitical events. Thank you for tuning in. Let's jump into the next episode.